Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking time out of your busy day to share it with us. We have an information-packed show for you today. That's really the only way I can put it. A lot of information. We're going to talk about hurricanes. We're going to talk about geopolitical events, interest rates, central banks, corporate earnings, all of that and a lot more on our show today. A lot of the questions and topics that I've been talking to people about, answering questions on investing and ideas over the last couple of weeks, really brought us to a long list of ideas for our show. And it was difficult to cut a few out. So I said, what the heck, let's put them on our show this afternoon. So let's put up our show ideas or segments for today. There you have it. We're going to start the show with central banks and inflation, probably the number one idea or the number one thing that most investors, analysts are thinking about. When will the Fed and Bank of Canada cut again? Will it be next meeting? If so, by how much? And how quickly are they going to, how quickly are they going to have their pace for interest rate cuts? Are they going to speed it up, slow it down? What are they going to do? We'll talk about that. Top 3 things to consider over the next 10 business days before you make your investment decisions. As always, that's a staple on our show. We have 3 ideas for you today. Diversification versus looking for value, or not so much versus, but diversification and looking for value. A lot of people talking to me about, Allan, how much tech should I own in my portfolio? How much NVIDIA should I have in my portfolio? Well, I don't think those are the right questions to be asking, to be honest. I think you want to look for value, and wherever value takes you, that's where you want to go. TD Bank money laundering penalties. Most of you have probably heard that TD Bank got into some trouble a little while ago. Money laundering, unfortunately, happened at TD Bank. TD Bank in the United States, not here in Canada. And what are the penalties that the U.S. government are now implementing or coming through with on TD Bank? We'll talk about those. U.S. hurricanes in the market. We just saw 2 powerful hurricanes reach the coast of the United States, in Florida, the Carolinas. How did that impact the markets? How do these types of really horrible events, how do they affect markets? And we'll talk about that as well. Lastly, or second last, quick hits. Talk about 3 topics that individuals might be seeing in the news today. I'll comment very briefly on all 3. These are things that you've probably seen online, media, on the news, and we'll chat about those. And last, your questions. I always like to take 1 or 2 of your questions before we sign off. If you have any questions for me while the show is going on, please put them in the chat box. Love to answer them throughout the 2 weeks until our next show, or perhaps answer them on our next show. So without further ado, let's get on with this action-packed, or information-packed, I should say, show this afternoon. Central banks and inflation. So as I said off the top of the show, this is the number one idea, the number one thing investors and analysts and economists are talking about as of late. Will the Bank of Canada lower rates again coming up at their next meeting next week? If so, by how much? 25 points, 50 basis points. Will they go another 50 after that, or just a quarter? What about the Federal Reserve? For a while there, we were talking about Federal Reserve being behind the curve, not raising fast enough. Now, all of a sudden, we're talking about a strong U.S. economy. Will the Federal Reserve cut rates again this year? Will they go once? They have 2 meetings before the end of the year. Will they cut 25 basis points? Will they cut 50 basis points? A lot of the questions that need to be answered. And these are the main, or interest rates, in my opinion, is the main thing that affects markets, right? If we knew, if the Fed and the Bank of Canada were to come out and say, on such and such date, we're going to cut 25 basis points, well, the market would be in much better shape. We would know in advance of what's going on, but we all know that's not what happens. Central banks say they are data dependent. So what do? As investors, we look at the data. But what if the data is mixed? And that's what we have currently. Some data is strong, some data is weak. Some data should be coming down faster, like inflation, not enough. And in the case of living in Canada, perhaps inflation coming down too far. A 2% target is what the Bank of Canada and the Fed talk about. Well, last reading here in Canada, 1.6% was our inflation rate, CPI in Canada. So is that too much? So all the data coming in has been mixed, and we have a number of charts I want to get to that will show you what is happening with all this data. But what I will say before we get to the charts is, in my opinion, I think you have to go with the standard. And what the standard to me is quarter point cut in Canada, quarter point cut in the US. If they cut 50 in Canada, I think that is bonus. If they don't cut in the US, well, that I think can perhaps ruffle the feathers of the stock market. The hope is that they will cut again, a quarter point at least. But keep in mind, right? TSX and even the markets in the US, they're at all-time highs. So these central banks will be cutting interest rates when markets are at all-time highs, something that we don't see often. I think the last time we saw that central banks cutting rates when markets were doing extremely well or at highs was back in the 90s. So it's been a long time that we saw central banks cut rates while markets have been at all-time highs. So let's move to our first chart, which is the Canada's inflation rate for September. And we'll show very quickly that, yes, there it is, easing to 1.6%. You could see the Bank of Canada rate 4.25%. Most banks thought, most main or large banks in Canada thought that we would see 4% by the end of the year, which means a quarter point cut, perhaps this meeting or their last meeting of the year. Now we're hearing maybe 2 quarter point cuts, so maybe 3.75 bank rate before the end of the year. But you can clearly see that with an inflation rate at 1.6%, which is well below the 2% target, Bank of Canada has a lot of leeway into cutting rates further. And when you compare the bank rate with the inflation rate, wow, it's almost 3 times the actual inflation rate, way too high for many individual investors and analysts. Going to our next chart, we'll show US CPI, which is the US inflation rate. You can see here that the headline rate is 2.4%, also coming down significantly. Core rate, 3.3%. That too is coming down. Obviously, the Fed still wants to get to 2%. And the question is, will they get to 2% anytime soon? Well, with the trajectory that the inflation rate has been taking, I think they will. I don't know about core, but it'd be nice to see core somewhere around 2.5 with the headline number at 2%. So inflation definitely moving in the right direction. And that is definitely a cause, or at least something that the central banks can use to say, okay, now it's time to cut rates further. So validation, if you will, for interest rate cuts. In the US, our next chart, PCE, we talk about that all the time, another measurement for inflation. And you can see here, core PCE, 2.7%, which is excluding volatile food and energy, and the headline number, 2.2%. So if you were to ask Jerome Powell, the head of the Fed, I'm sure he would tell you that inflation is hovering around 2 to 2.5% currently. Going forward, jobs. Now, this is something that causes us to have a bit of a, I guess, pause here with respect to interest rate cuts, because jobs have been strong the last couple of months. Our first chart here, Canadian job creation for the month of September, almost 47,000 jobs created, well above the 22,000 jobs that the market or that analysts were anticipating. We also saw a lot of good job growth for the month of August. Prior to that, June and July, obviously, we saw negative jobs creation. So definitely a rebound in jobs. Again, will the Bank of Canada take that into consideration? Economy is doing a little bit better. We're seeing better growth numbers, GDP and jobs. So that might mean maybe the Bank of Canada can continue to cut rates, but more at a more measured pace. So don't have to make these big jumbo cuts, as the rumor going around is talking about for next week. Maybe they just go slowly, gradually, which I would say, in my opinion, would be probably the better move. Our next chart here is US job creation. And again, 254,000 jobs created for the month of September. And you can see from probably around March to about, let's call it June, a nice gradual downward trend in job creation. Now, all of a sudden, if you go from June to September, it's now gradually working its way back up. Once again, showing the resiliency of the US economy and showing how strong things are, how good growth is, jobs, a great measurement for the Fed. And if he starts to see jobs fall, which they were seeing for a short period of time, they talked about cutting rates because, as we know, there's a dual mandate that the Fed and Bank of Canada have. They want full employment and they want price stability. Price stability seems to be already happened. Inflation's coming down. Job growth was coming down, but now that's come up. And that's why you're hearing a lot about the soft landing or no landing scenario, meaning the economy is just doing fine. The Fed was able to do what they needed to do to bring inflation down, and the economy is still humming along. The next chart we have here, Canadian unemployment rate actually ticked down a little bit to 6.5% in September. If you look to the far right, very slightly a tick down, but you could see that it had been moving higher, as high as 6.6% over the past few months. We go now to the U.S. unemployment rate, again showing you, I guess, a bit of a fall in unemployment from 4.2-ish to 4.1%. Again, telling us that the whole situation regarding jobs creation, and even growth is definitely doing a lot better in the U.S., doing a lot better in the U.S. than here in Canada. But even in Canada, we're seeing some positive data. A couple of more charts we have here. Bank of Canada cuts for the third time. We saw 3 cuts already by the Bank of Canada. You can see it there, 4.25%. Will they cut a 4th and 5th time, bringing the rate down to perhaps 3.75 if they go 25 basis points? That is the question we're all asking. And our last chart, last but not least, Federal Reserve. They've cut once, but it's 50 basis points, half a point cut. And you can see there the trajectory for cuts going forward. So all in all, I guess after all these charts, I guess my main message is this. What we're seeing is mixed. We're seeing strong data. We're seeing strong data in jobs, GDP growth. I think they're talking about a 3% growth rate for the current quarter in the United States. Very high. We're seeing weakness in some things. And so when you combine the two types of signals that we're getting out of the data, it's mixed. And that is why a lot of individual investors and analysts are having a difficult time figuring out whether banks are going to cut, central banks will cut, by how much and how quickly. And I guess we're going to find out in about a week's time what the Bank of Canada will do. And then early on in November, I believe just after the election, we'll find out what the Fed does. But for now, I think any signals by either central bank will be key for how the market will perform over the next, let's call it, month or so. Another part of the show where we talk about three ideas that individual investors should be focusing on or keep in the back of their minds before they make their investment decisions. And here are our 3 topics for this show. Corporate earnings. We're now entering into the corporate earnings season. We've pretty much seen most of the big banks in the United States report earnings, and they've pretty much all been blowout earnings. They've all performed extremely well, beating expectations, top, bottom line. Everything's been going quite smoothly up until now. Second, valuation stretched. We talk about valuations of the stock market quite often, and a lot of people talking about this time valuations, the S&P 500 trading above norms, so slightly overvalued perhaps. And our third point, geopolitical concerns. These are all unfortunately in the back of our minds, what's going on in the Middle East, what's going on Russia, Ukraine, and anywhere else in the world. A lot of rumblings out of China, what the relationship between China and the US, at times okay, at times not so good. So we have to keep an eye on all these things, and definitely something that I wanted to touch on for our show today. So let's get to our first one, corporate earnings. As I mentioned, we are in corporate earnings season, just started with the main US banks reporting. And as I said, unbelievable results. JP Morgan, Wells Fargo, Citibank, Bank of America, Goldman Sachs, and as early as or as recent as this morning, Morgan Stanley, all reporting great earnings. They're seeing investment banking doing well, net interest margins, so the spread between what they lend money at and charge and what they pay on their savings accounts and GICs. That spread, we call it net interest margin, doing well at most of the banks. Even though JP Morgan said it wasn't going to look as strong, they actually came in with pretty good results. Trading was good at all these banks, especially Morgan Stanley this morning. Wealth management fees are going up. Whenever the market goes up, remember, a lot of these accounts pay a flat fee for the year, and it's based as a percentage of the investments. And as the investments rise, so do the fees, so do the costs of managing those portfolios. So any of these wealth management fees, they're going up at the banks as well. So the banks really making a fantastic run this past quarter. And we've seen their stock prices moving in tandem with the results. So a couple of charts we have to start off. Let's look at the biggest bank in North America, one of the biggest banks in the world, JP Morgan. And we have a chart of JP Morgan here. There you go. It came down a little bit, but has now recently surged back to all-time highs. We have a chart, next chart here, Wells Fargo as well. You can see a nice run up on the far right-hand side of that chart. Wells Fargo making a great run. Wells Fargo, arguably the third largest bank in the United States, just after Bank of America, probably just before Citibank as well. Now, earnings season, you could say, okay, well, that's the banks. But for many people, and with the S&P 500 being 50% pretty much technology, the earnings season, for some, they'll say, well, the earnings season doesn't start until we get tech earnings. And that could be a good point. And that happens all next week. We're going to get Tesla earnings. We're going to get Google earnings shortly after. Following week, we're going to start to get more of the Mag 7, Amazon, and other names reporting. And we know how crucial the Mag 7 is to, I guess, overall investors' returns, to the stock market in general. We have a chart on the Mag 7 that we can show. There it is. You can see there have been a bit of a few blips in the last few months with respect to, is there a slowdown in the overall economy? Is there a slowdown with some of these tech names? But you could see any blip down has been bought quite strongly, actually. And you can see that the Mag 7 perhaps not at its all-time high. That was reached sometime in the summer, July, August timeframe, but still very, very strong. And as I tell people, I still believe, yes, even though the market breadth has widened, even though there are a lot more names participating in the rally, I still believe you need to own technology. And one stock chart that I wanted to put up here with respect to earnings season, that's Taiwan Semiconductor. And that's a name that a lot of people don't talk about, a name that I don't talk much about on our show. Taiwan Semiconductor, global chip maker. NVIDIA is their client, amongst other companies as well. And it's a name that is doing phenomenally well with artificial intelligence booming, chip making booming. Taiwan Semiconductor is a chip maker, and they're doing extremely well. They report earnings tomorrow, actually. And with a chip maker in Europe reporting yesterday, reported earnings that weren't so great. Chip makers all over the world sold off a little bit. If Taiwan Semi reports strong earnings, which I believe they will, we could see a resurgence in some of these tech names once again, like NVIDIA, AMD, and many others. So Taiwan Semi, I wanted to put that up today as a name to keep an eye on. Reporting earnings tomorrow. I'm hopeful that they will be great. So overall, I think you need to keep one eye, or if not both eyes, on corporate earnings season, especially as we get into the tech names. Second topic that I wanted to discuss, valuations stretched. And it's interesting because, and actually we can show the S&P 500 chart. We can put that up as I speak. But the S&P 500, a lot of people talk about, well, yes, the S&P 500, there it is doing so well, but that's on the back of these Mag 7, Magnificent 7 stocks, the big cap tech names, because they are such a large component of the S&P 500. It's no wonder that the S&P 500 is doing as well. And if you factor out those names, then the market actually is not expensive and it's not, valuations are not stretched. Well, don't know if that's so true anymore. So here's the S&P 500, and you can see how well it's doing. Now, if I were to show you an equal weighted S&P 500, so that means not overvaluing or looking at these names, that the biggest tech names and their how much they make of the S&P 500, how much of a component to the S&P 500 these 7 names make. If you took everything and equal weighted it, what would the S&P 500 be doing? Well, here you have it. S&P 500 equal weight index, and it's still way up and up quite a bit. So does that tell us that valuations are okay? No, I think for many names, valuations are a little bit stretched, and you have to be mindful of that. You can't just go ahead and chase your favorite tech stock, your bank stock, pharmaceutical stock, or oil stock, or whatever company you're looking at. You have to look at valuations, and valuation is extremely important. Our next chart here, you can see PE ratios, how high PE ratios have surged. You can see the colored area there is more of a normal area, or what we would call normal range for PEs. And you can see how much PEs are stretched. So overall, to me, I think valuations, stretched valuations, is something that individual investors need to consider before they make their investment decisions. Our third and final point for today, geopolitical tensions, geopolitical concerns. In particular, what's going on in the Middle East. Obviously, we've seen a lot of back and forth between Israel, Hezbollah, Hamas, and Iran. Iran recently sent in, I think it was something like 200 missiles into Israel at the beginning of October. And, what did that do to the market? These geopolitical concerns can definitely cause the markets to pull back. They can cause the markets to have a difficult time. First chart I wanted to show, actually, we can show the S&P 500 index. We can show the Iran missile attack and what it did to the markets on that day. And there it is. So you can see Iran missile attack on Israel was the beginning of October, and you saw a gradual, leading to the beginning of October, a gradual upward, upward slope of the market. And then Iran sent those missiles into Israel, and you can see how quickly the market sold off. And it wasn't until, I would say, sometime around maybe after the first week of October, did things start to pick back up again. So these geopolitical tensions, concerns, they can cause the markets to definitely do different things, sell off, unfortunately. And we also saw WTI, oil, and how the effects of oil and what's been happening there. So let's put up a chart on oil, and you'll see that when the tension started in the Middle East, oil shot up, which makes sense, right? Iran's a big producer of oil. There was talk that Israel would retaliate and take out some of their nuclear facilities, some of their oil refineries. And so because of that, price of oil shot higher. Well, in the last couple of days, for some reason, I'm not sure, some information was leaked. And it seems that Israel has said that they will not attack those areas of Iran, and instead they may go after other facilities, perhaps. So you are now seeing the effects of that. Price of oil shot up to quite high, maybe in the mid to high 70s, and now it's pulled back just above $70 a barrel on the news that no, Israel may not attack the refineries and attack the oil infrastructure of Iran. So you can see how volatile geopolitical concerns and risks can be to the market, to people's portfolios, and definitely something to consider with the other two topics as well before you make your investment decisions over the next 10 days. Diversification, looking for value when you're building out your portfolio. And as I said off the top of the show, I get a lot of questions asked regularly. Allan, should I buy NVIDIA? Should I buy more NVIDIA? Should I buy some of the chip makers? Amazon? Should I buy Microsoft? Should I buy Apple? And everything seems to be revolving around tech. And now, I guess probably since the summer, not only are things revolving around tech, but now people have been starting to talk about, individual investors have been discussing other investment ideas. So is it the Magnificent Seven stocks, the big 7 tech names, or is it the other 493 stocks that trade on the S&P 500? And this has been a question. Do you buy tech or do you buy other names? And I want to say today to all of you watching, I don't look at it that way, and I don't think you should look at it that way either. What I would rather see all of you and what all of you do and what I do on a regular basis is I look for value. And I look to diversify portfolios based on the value that I find. So I don't start off by taking a piece of paper and writing down my favorite 10 tech stocks and then buy a few other names. I look for value right away. Where does value take me? If it takes me into an area where perhaps we're overweight tech, then so be it. If it takes me to other areas and we're underweight tech, then that tells me something as well. I can tell you right now, valuations, as we said, are a little bit stretched. I'm finding it difficult now to find good quality investment ideas. They're taking me longer to find, and that tells me, yeah, things are a little bit stretched in valuation. And is that a reason that we should panic and sell our investments? Absolutely not. But it just makes it a little bit more difficult to find those diamonds in the rough, to find those good ideas to add to portfolios. But we start off with finding value wherever it may be, jotting down those names, and then structuring them almost like a jigsaw puzzle into a portfolio. To me, that's how we build portfolios. Starts by looking for value and seeing where that takes us versus thinking about tech versus other investment ideas, big tech, small tech, the other 493 stocks. I just don't think you need to do it that way. Our first, I guess, picture or chart, whatever you want to call it, is about value investing. And actually a definition of value investing, there it is. Value investing is an investment strategy that focuses on stocks that are underappreciated by investors and the market at large. Investors who use the strategy hope that the stock price will rise as more people come to appreciate the value of the company's business. And there you have where you want to find a stock in the, I guess, the bottom right quadrant. So good value or high in the value category and low in the price category. And those are investments that I talk about all the time that are on sale, right? You want to buy things on sale. You want to buy low to sell high. And sometimes my clients or investors will say to me, why are you buying this name? It's not doing well. And I say, well, that's exactly why I want to buy it, because the business is doing well. The stock price just hasn't reflected the business as yet. Next chart I have here, you can clearly see how many sectors in the S&P 500 are doing phenomenally well. So why are you going to limit yourself to just tech or make that differentiation between tech and other? There are so many names that go into the other categories, so many other sectors, real estate sector, consumer staples, utilities, financials. These are areas of the market that are doing extremely well that, yeah, if you find value in, it could be part of a nice diversified portfolio. And you can see all these numbers. And I guess what stands out to me is how high these numbers are. Unbelievable, the amount of growth in all sectors. I think you're hard pressed to find any sector really that has struggled over the last year or so, even 5-year basis. So I think building diverse portfolios is what you want to do. You want to start with value and then from there branch out. And if that means overweighting a certain area, well, that might make sense. If it means having everything equal, that might make sense as well. So try not to look at tech versus other. I think you just want to find the best value you can and build portfolios from there. TD Bank, it's a stock that I've been asked about quite a bit in the last few weeks. Of course, we just received the information that TD Bank will face penalties because of their money laundering situation. For those of you that don't know what happened, TD Bank, unfortunately, in the United States, again, not here in Canada, unfortunately got involved in some money laundering scandal and some employees at the bank, from what we hear, although I don't think it was ever proven, but we hear some employees that were involved, and the United States government believes that TD Bank put profits ahead of everything else, including compliance and making sure these things don't happen at their bank. And so when they were caught money laundering through TD Bank, then the U.S. government came down quite hard on the bank. they face just over $3 billion in fines. Now, a lot of investors ask me, is that a lot? Is that a big number? It sounds like a big number, $3 billion. Well, I think the bank, TD Bank, can take care of that, right? TD Bank's the 10th largest bank in the United States, if you can believe it. I had to do a double take on that one. I didn't think they were that large. And they set aside $4 billion for a fine. So $3 billion, less than four, they were okay. But what the issue is and why the stock has dropped about 10, 12% in the last, I guess, few days even, was because the United States government put an asset cap on TD Bank. Now, what is an asset cap? Well, TD Bank in the US has so much in the way of assets. I think it's about $434 billion of assets. Unfortunately, that is actually, I think it's slightly below that, but they put a cap of about $434 billion on their assets in the United States, meaning they cannot grow beyond that, which means they cannot go out and acquire a bank or anything in the United States that would take them over their asset cap. We know that TD Bank, just after the pandemic, they wanted to buy some regional banks in the US. Unfortunately, that deal did not work out. They were sitting on a lot of cash. Everyone was anticipating them to announce another deal, and they never did. Obviously, they continue to buy back shares and dividends they pay out, etc., uses the cash that they have. But I'm sure the bank would love to continue to make acquisitions in the United States. And unfortunately for them right now, that is not going to happen. They are capping, the United States is capping what TD Bank can do in the US for now. How long that cap will last remains to be seen. Perhaps it's a few years. I know Wells Fargo, another US bank, they've had a similar situation handed down on them, and they're still involved in their asset caps. And US government is still not letting Wells Fargo do what exactly they want to do. So hard to say how long this will last. We have a chart up on TD Bank. We can pull that up here. And you can see on the far right, it's almost like someone just jumped off a cliff there. And perhaps we can use that analogy for TD Bank stock. It's a straight line down, unfortunately, from about $87 to approximately $77, about a 11, 12% decline. And it happened, just in a few days. And the question I've been getting is, what do you think about TD Bank as an investment idea going forward? Well, in my opinion, I think in a couple of years, you're going to be fine. I think the next few years will be a little bit challenging for the bank, for bank earnings. Overall tone of owning shares is a bit negative right now. There's a negative tone to TD Bank right now until that fades over time, because as we know, time heals all. I think TD Bank shareholders, if you're looking to buy, you can. It pays a very nice dividend, 5.6, sorry, just over 5% dividend, which is great. And I think that dividend is secure. So if you're buying TD for a bounce back, I think you will see it. It just may take a little bit of time. But outside of that, I still believe TD Bank's a fantastic bank, second largest in Canada. They make still a tremendous amount of money in Canada, so I don't think we have to worry about that, how much money they take in. But definitely understand that if you're buying the bank, they are definitely limited in the United States, which has been a region that TD Bank has grown so much over the last bunch of years. U.S. hurricanes. It's definitely hurricane season, that's for sure. And hurricane season usually lasts until the end of October. We just witnessed two big hurricanes, Helene and Milton, I believe, hit the United States, devastating a lot of Florida, Central Florida, the Tampa area, just south of the Tampa area, and totally devastating the Carolinas. And I think if you're anywhere in North America, you can't help but to turn on a TV or online to see the devastation. It's quite sad. It's many people's lives have been turned upside down. It's quite unfortunate and sad. From an investment perspective, what do hurricanes or these catastrophes, these negative events have on the markets? Well, usually they're short-lived, whether it's a war, whether it's an attack, whether it's a hurricane, something to do with weather or anything like that. the effects are usually short-lived. You have the event itself, things can linger for a little bit longer, and then the market seems to pick up and get back on its feet. I know a lot of individual investors have been trying to figure out the impact of the hurricanes in the United States. What types of investments you could possibly buy that maybe can actually do better because of the rebuild, the amount of rebuilding that's going to go on in Florida and the Carolinas. Where should you be looking? And I have a chart on some of the sectors that have been impacted positively and negatively by hurricanes in the past, and we can put that up here. You can see the first one, yes, home improvement companies. I know a lot of individuals looking at buying shares of Home Depot or Lowe's, because where are people going to get the supplies to rebuild their homes, to rebuild parts of their homes, rebuild infrastructure in general? Well, they're going to go to Home Depot. They're going to go to Lowe's. They're going to go to the places where they can get what they need. And so Home Depot, not a coincidence that it is trading at 52-week highs and close to all-time highs right now. But I think you have to also be careful a little bit, because like any large business, in large retail business in the United States, Home Depot has a lot of locations that are in Florida, that are in the Carolinas. And a lot of those locations may be not open. They may have been shut down and may be shut down for quite some time. So on one hand, yes, you might see a lot of traffic in these places, but if these locations are shut down, what is that going to mean to the top and bottom line for the company? So on one hand, some positive, perhaps on the other hand, some negative, and how is that going to factor out when they report earnings? Generator companies, obviously self-explanatory. You lose power, you need a generator. Engineering companies, you need engineering companies to help with the rebuild. Battery makers, water solution companies. Obviously, when these hurricanes hit, they affect the quality of the water, and all the water companies are needed to help with that. And last but not least, our insurers. How much are the insurers going to have to ante up to the people to cover a lot of the damage that has been had? You tend to find that insurers, after a situation happens, they tend to make their insurance coverage a lot more narrow, a lot more focused, because they're not really happy to dish out all this kind of money. So overall, as an investor, yes, hurricanes and other negative events can affect the markets. Usually short-lived, either a spike or a downturn, and then it's followed by cooler heads, I guess. Cooler heads prevail, and we get back to normal investing. I guess our second chart for this segment is one I find quite interesting. Top 10 costliest U.S. catastrophes, adjusted for 2023 dollars. And you can see here, Hurricane Katrina, $102 billion in damage. 9/11, that's not obviously a storm, but 9/11 terrorist attacks on the U.S., how much that hurt the United States. Hurricane Ian, followed by COVID. You would think COVID would be probably number one, but it's not. You're looking at number 4. Hurricane Ida, and then you have all the hurricanes after it, Sandy and Harvey and Irma and Andrew. I remember Hurricane Andrew. It hit Florida quite hard way back in '92, and back then it was something to see. But look how many large hurricanes have unfortunately come after it. So I guess to sum up, hurricanes definitely and events like that, whether it's a hurricane or another negative event, definitely affect markets. They can affect oil prices. They can affect the general market. They can affect all types of companies. The effects tend to be short-lived, but definitely pronounced. Very sharp turns either to the downside or the upside. But as I said, overall, the good news is cooler heads end up prevailing. And as investors, if you can take advantage of a short-term blip in the markets to the upside, why not? But overall, for most investors, it's something that you probably just want to stay away from. Quick hits. This is something we added to the show, I think now about a couple of months ago. And this is where I talk about 3 things that I've been seeing a lot in the news today. I know a lot of you watching probably are as well. First one, Boeing. We've heard how, difficult a time Boeing has been having, whether it's the construction of their planes, whether it's the issues that they've had with their planes while flying And recently, strikes. Boeing machinists are on strike, and without them, they can't build planes. So Boeing is losing money every day, and we'll talk about that. Oil prices dropping. We touched on that earlier in the show. Why did oil prices drop? And third, activist investor getting involved with Pfizer. What is an activist investor? We'll talk about that, and we'll talk about why they've chosen Pfizer and perhaps what the stock is doing because of it. So let's move to the first one, which is Boeing. I think while I talk about Boeing, we can show a chart on just how much Boeing has borrowed in the last, well, let's call it little while. You can see that spike up. Well, Boeing, one of the largest companies in the United States, employs probably, I guess, if not the most people in the United States, but one of the biggest companies employing U.S. Citizens, individuals in the U.S. And unfortunately, they have pretty much grinded to a halt in many ways. And obviously, they've now laid off, furloughed, as we call it in some cases, laid off a number of workers. They aren't building planes because they can't. Their people are on strike and really causing a lot of damage for now. I think the strike is into its second month. And you can see how much Boeing is or has recently borrowed to keep things afloat, to keep things going, to meet their debt requirements and their debt obligations. So something to keep an eye on is Boeing's situation. I know a lot of investors own Boeing shares. And, the good news is Boeing still remains one of only two plane makers in the world, Airbus and them. And once they can figure out the strike situation, I'm hopeful we will see a big spike up, instant spike up in the share price. And they can get back to what they do best, which is building planes and building more planes than they were even before. So something to consider, and something I've been watching in the news has been Boeing. Oil prices drop. We talked about it. We have, again, a chart on oil prices, a shorter term chart, which shows the price of oil fall significantly. And that is just based on the fact that if Israel does not attack Iran, their oil refineries, their energy facilities, then Iran can keep pumping oil. They pump a lot of oil. There's also talk that the Saudis and other OPEC nations will start to increase their oil production. We know that the U.S. pumps over 13 million barrels a day. If former President Trump were to be reelected, there's talk that he would pump even more than that. So the price of oil could easily fall to $60. Some have said $50 a barrel, WTI. I'm not sure. Obviously, the price of oil is being inflated from time to time because of geopolitical events like what's happening in the Middle East. So take away those events, and yes, the price of oil probably goes down by at least maybe 10%. I think is definitely something that can happen. So oil falling is definitely something that many of us are going to pay attention to. Obviously, it affects us at the pumps when we go to fill up our cars. Our third quick hit and last one is activist investors are getting involved with Pfizer stock. So what's an activist investor? An activist investor is a business, a person, usually part of a business, that gets involved. They buy a lot of shares of a company, in this case, Pfizer. And they buy enough shares where they can then demand a seat on the board. And if they get one or maybe two seats on the board or however many seats, they can hopefully affect change at the company. So these activist investors, their idea is they want to see change. They believe the company should be doing better than it is, and they want to see change. And usually when an activist investor gets involved, you see the stock rise. And we saw the stock rise of Pfizer. And since then, actually, in the last week or so, that activist investor called Starboard, that's the business, they actually said that they've sort of softened their stance and that Pfizer board is doing a good job. And they met with the CEO and they like what they see and they don't think Pfizer is going down the wrong path. So because everybody was hoping that Starboard would affect change for the better, for the share price, now investors are thinking, well, doesn't sound like it because Starboard seems to be okay with what Pfizer's doing. So we've seen the shares of Pfizer fall. And we have a graph of Pfizer here, a chart of Pfizer. And you can see on the far right-hand side, it blipped up and came down as well. But I still think, regardless of activist investors, Pfizer's a very good company. They've gone into the oncology area, which is huge for them. They have great cash flow. They've taken up their earnings for the coming quarters. So they've raised their guidance for how much money they're going to make. They also pay just under a 6% dividend. So a very good quality investment to own. So regardless of whether the activist investor continues to be involved or try to get more involved with the name, I think a name like Pfizer can be and should be a name that individual investors look at for a nice diversified portfolio. Now it's time to take as many questions as I can from our audience. I know we usually have a few questions that come in during the course of the show. I see here a couple of questions came in, and let's see. I'm going to take the second one here. If I want to set up a conservative portfolio, should I be investing in equities or bonds? What percentage do you recommend to your clients? So I think that's a good general question. We talked about building portfolios earlier on in the show, diversification. And this question talks about if you want to be a conservative investor, should you own stocks and bonds? Well, I guess the way to answer that question is, what the types of returns you want to obtain, you want to get, types of returns you need to reach your end goal, to reach your investment objectives. Because obviously bonds tend to pay less. They pay interest. Today you probably can find bonds, shorter term bonds, 4.5%. If you're looking at stocks, well, stocks obviously have outperformed. You saw the numbers earlier on that chart showing all the different sectors. There's some stocks, some individual investors in these stocks making 20, 25% returns this year and last year. So pretty big spread between what bonds and low risk is paying and what medium risk is paying. So it really just comes down to what you're looking for, how much you want in bonds versus stocks, how much you want in low risk versus medium risk. And I would say that, we talk about the classic 60-40 split, 60% equities or stocks, mutual funds, et cetera, and 40% bonds. Today, that type of split would probably give you an 8% rate of return, in my opinion. If that is good enough for what you need to accomplish for your investment objectives, then there you go. 60% equities or stocks and mutual funds, and maybe 40% fixed income. So that's an idea on how to look at it. But overall, I just don't think you can come with an idea, I want so much bond, so much stock. You need to look at it in terms of what's the overall rate of return you're requiring to reach your investment objectives. And in my opinion, that is what you need to do. And that's how you figure out for conservative investors or aggressive investors, how much stock and how much in the way of bonds you should have in your portfolio. So with that, I'd like to say thank you to all of you for watching watching our show this afternoon. Hopefully, as I say always, you can take away at least one piece of information. I know there was a lot of information thrown at you, so hopefully most of you can take away more than one piece today. A lot of great information, and I look forward to seeing all of you again 2 weeks from today, which is Wednesday, October 30th, the day before Halloween. So for all of you that have little ones, I'm sure that you're getting excited for Halloween coming up. But we will be back at 12 noon, Wednesday, October 30th. And until then, happy investing.